Cramer. Welcome to Mad Money. Welcome to Cramer. Other people make friends. I'm just trying to make you some money. My job, not just to entertain you, but to educate you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. So many of the top people in this business give up so easily on the best investments that it's a marvel anyone makes money in stocks. They're way too eager to capitulate. That's how I feel about two of my absolute favorite stocks, NVIDIA and Apple, both of which exploded higher today on tremendous news, powering a market that looked soggy at the opening, but then turned around in spectacular fashion, with the Dow advancing 66 points, S&P climbing 0.44%, and the Nasdaq gaining 0.70%. I want to spend some time on these two, because it is vital for you to realize why so many people cannot make money in this market, cannot, or in any market, something I spend a huge amount of time writing about in my new book, How to Make Money in Any Market, which comes out next week. My premise has long been Wall Street and its media acolytes constantly encourage you to trade. Sell. And you're going to end up trading out of the best stocks of any era. As a result, you end up missing the biggest moves in these stocks because you know what? They occur when you least expect them, like today. Then, because so many people refuse to own stocks through thick and thin, the establishment says, well, it's impossible for you to make money in the market, so you might as well just stick with index funds. Forget about catching the big ones. You can't do it. Instead of getting the ones with the huge profits that could have been yours had you stuck with the stocks of NVIDIA or Apple, which you know I like so much, you have to be satisfied with much lower returns. I wrote How to Make Money in Any Market to combat this terrible conundrum that continually keeps people from getting rich in individual stocks, something that can only happen with disciplined investing, as opposed to ill-advised, often reckless, almost always harmful trading. So let's take what happened today with the stocks of Apple and NVIDIA. It is so instructive. First, Apple. For the last 2 weeks, I've been trying to get across to you that this launch of the iPhone 17s would be very different. These are incredible new models, including one that's as light as a candy bar in the hand. Sure, there's always the possibility of a belly flop, but for years, my strategy has been to own Apple, don't trade it. And the more I studied the new models, the more I realized these were really special. I figured they'd ultimately reward disciplined investors who stick with Apple as long as it offers the best products. That's been the thesis. And these are still the best products. Apple kept the faith of the committed investor, including my charitable trust, where I've demonstrated my fealty for years. If you didn't catch my enthusiasm in Kentucky when we spoke with Apple CEO Tim Cook at the Corning factory, where all the iPhone cover glass will soon be made, well, then you might have sensed it when I interviewed Cook at the actual 17 launch in New York City. But I was up against a negative narrative, a wall of negatives about Apple, spread by both the buy side, meaning the hedge funds, and the sell side, meaning the analysts. This narrative flooded the media. No, it owned the media, subjecting you to a constant barrage of pessimism about Apple that would make all but the most stalwart owners, or maybe the clueless ones, check out of the stock. Sell. We heard that the phones weren't that different from previous models. They were yawners. We heard that they wouldn't sell well in China. We heard that tariffs would hurt sales because the phones would cost $200, $300 more than people thought. We were pounded with that narrative list. Well, without any homegrown artificial intelligence, by the way, sales would have to be tepid, right? Incredibly, every one of those negatives that made you want to dump Apple, in fear, of course, is proving to be untrue. From the crowds mobbing Apple stores in China, it looks like the launch is going spectacularly. And they don't even have all the models for sale in the PRC. There are adherents for each phone. Cook told us that when you take the trade-in value and you add on the incentives to the wireless carriers, the price really hasn't gone up at all, despite the tariffs. As far as AI, Tim showed there's a remarkable amount of artificial intelligence in these phones. And as far as he can tell, nobody's switching the competition like a Samsung just for better AI. It's a yawner to the faithful. That negative narrative seemed busted to me. But going into today's session, Apple stock wasn't even up for the year. Then this morning, Mike Sievert, the CEO of T-Mobile, came on Squawk on the Street to announce his retirement. I remembered a few years back another time when people thought that Apple sales would be weak. But when I caught up with Mike, he said they weren't. They were terrific. That immediately turned Apple stock around. So I wasn't going to let him leave without asking him how this launch was doing. Here's what he had to say.
I can tell you T-Mobile's iPhone sales are at all-time record highs. We just had the biggest iPhone weekend. We're up double digits from a year ago. And you know what our last biggest iPhone weekend was? Last year's. We're up double digit from that launch.
Boom! Right in the face of a typical piece of bearish piece of sell-side research. It's this morning. The Apple bulls at last took charge of the story. The stock shot up more than 4% in response. It's a big cap stock. Unfortunately, as I explained in my book, the constant deluge of negativity that passes for research on Apple scared most people away. I hope it didn't scare you away from the stock. So I don't know how many people ultimately got to the promised land of profits. Those who say trade it, don't own it, got blown out once again. Another reason why the classic growth stocks, as I say over and over, should not be traded, just owned. And NVIDIA, the ultimate own it, don't trade it stock, is another one. For weeks now, we've been bombarded with questions about demand for NVIDIA's chips because of concerns about China. We followed every move of the negotiations between our two countries. All we've gotten are endless reports about intransigence on both sides. Because of the tough negotiations with China, it looked like NVIDIA is going to stall out. Plus, we keep hearing from the usual knaves, fools, and dissemblers that China's catching up to us and surpassing Jensen Huang's fabulous company, ultimately leaving the United States in the dust. Then today, NVIDIA announced a deal with OpenAI to build data centers with a capacity of 10 gigawatts worth of power. Do you know that's enough power to take care of 8 million homes? NVIDIA will invest $100 billion in OpenAI as part of the transaction. Will put up $10 billion per gigawatt. OpenAI is privately held, but when you get a deal like this, it will boost the value when it comes public. And I figure NVIDIA will continue to make fortunes from this investment. Sam Altman, the CEO of OpenAI, waxed endlessly in a CNBC exclusive John Ford Fabulous Job about the need for computing power to truly get what's needed out of artificial intelligence, and only NVIDIA has the power that's needed. The value of their 9-year partnership is now self-evident. This announcement brightened the entire data center food chain from the CoreWeaves and the Vertivs to the GE Vernovas and the Constellation Energies. I say, really, who cares about China? Only the people who traded the stock and are no longer in it, not those who owned it. Oh, it's discouraging. Anyway, the bottom line. It's incredibly difficult to make money in any market if all you're going to do is trade. Coming into this session, the enthusiasm for NVIDIA and Apple is almost nil. Traders were short or gone. The public stuck in index funds because they've been scared away from individual stocks. But as NVIDIA and Apple proved once again today, individual stocks are where the biggest money is, provided you got the fortitude to stick around and you aren't addicted to buying high and selling low, the ultimate result of endless trading. Let's go to Bill in Massachusetts. Bill.
Hey, Jimbo. It's Bilbo from Boston. I just wanted to thank you and your staff. You're doing an incredible job. You're hitting grand slams every week. It's amazing. I just want to thank you and your staff.
Bill. Thank you.
Honestly,
really appreciate that.
I can't believe how much I've came along. You've taught me so much. I used to say, boy, was I lucky. Boy, did I get lucky here. Now I'm realizing the education you've given me is amazing. I'm starting to pick stocks.
You're terrific.
Jim, I really do. Thank you. What I'd like to know is, you told me to buy Reddit at $45 a share.
Yes.
It went out of the park, home run, and I would love to buy some more. It's down about 10%. What do you think, Jim?
Well, look, I think you own some. I don't think you need to. I would not, as you know from the club, I would not buy more and violate my basis unless it is down more than it is. I like it. No need to buy more. That's what I told a lot of people. Total Wine more. A lot of them had Reddit. You got it. You got it. Just stay in it. David in Iowa. David.
Hi, Jim. Thanks for taking my phone call.
Of course.
Yeah, I'm interested in ConAgra. I see they're going to have an earnings report here pretty soon. The stock's been slipping in value, but the dividend's high.
No, you see, we want growth in stocks. We don't want dividends, particularly that are that high because maybe something's wrong. We like to buy stocks for growth. That's really the only elixir that will protect you from inflation and protect you at your portfolio from underperforming. Just pure growth, and ConAgra doesn't have it. Right, as NVIDIA and Apple proved once again today, individual stocks are where the biggest money can be made. On Mad Money Tonight, the Investing Club recently took a position in Boeing. I'm laying out why we made the move and telling you where I stand on the company. Then, with the averages making new highs almost every day, is there anywhere you can still put new money to work? I'm giving you my strategy for finding good investments at a reasonable entry point. And as AI demand is surging, I'm catching up with the CEO of quantum computing company IonQ to talk data centers, cybersecurity, profits, I don't know, and more. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Earlier this month, we started a new position in Boeing for the charitable trust. After years of disasters and operational missteps, I think CEO Kelly Ortberg has finally gotten Boeing's house in order, and I am betting the stock's got a lot more room to run. I've actually wanted to buy Boeing since the spring because it's maybe the most direct way to play President Trump's various trade wars. Trump wants our trading partners to buy more stuff from America, and the easiest way to close a trade deficit is by purchasing big-ticket items like commercial airliners. That's why I told you to buy Boeing in early June when it was trading at 209, and the stock charged all the way to 242 in late July. Since then, though, the stock has pulled back hard. Sell, sell, sell. Which is what finally gave me a good entry point for the charitable trust. In fact, with Boeing down nearly 10% this month and off about 30 points from its July highs, I think this is the opportunity for everyone to start a position in Boeing, especially if you missed the stock's big run this summer and spring. But buy some here. And then wait until it gets to $200 and buy some more. That's how we like to buy. Not all at once. That's a sucker's game. Last week at the CNBC Investing Club monthly meeting, I laid it all out for club members. So let me give you most of the important parts of the thesis that Jeff Marks and I explained to people. First and foremost, the whole world needs commercial aircraft, and there are only two companies on Earth that can make them at scale: Boeing and Airbus. If you want commercial jets, you got to buy them from one of these two companies. So when President Trump comes knocking your door pushing for some goodies as part of a trade deal, these countries orchestrate some big deals for Boeing. In May, the United Kingdom got a trade deal with the White House, and parent company British Airways agreed to buy $13 billion worth of jets from Boeing. During President Trump's visit to the Middle East later that month, Qatar Airways placed an order for 210 wide-body aircraft, including 130 Dreamliners. That's the largest order in the plane's history. At the same time, the UAE placed orders for 28 wide-body aircraft. In July, Japan said it would buy 100 Boeing jets under its trade agreement with the United States. Last month, Korean Air announced a $50 billion order for 103 Boeing airplanes with GE Aerospace engines. And just last week, it was reported that Turkey could be buying up to 250 Boeing planes. We've also been hearing that Boeing's close to finalizing a deal with China for as many as 500 jets. Buy. This would be the first order from the Chinese since 2017. So they've got the President of the United States going around the world drumming up business for them. Of course, Boeing's never really had a problem building an order book. It had a problem with execution, specifically quality control. For a few years, it felt like they'd forgotten how to build planes that don't fall apart, fall out of the sky. What the heck? But under CEO Kelly Ortberg, who took over a little more than a year ago, Boeing's finally getting its act together, and the company's ratcheting up production again with clear plans for how they'll raise the monthly production numbers, if the government will let them, for the core 737 and 787 aircraft. It will take some time, but I expect them to be able to make more and more planes per month, which will boost their cash flow, and that is the company's most important metric. Best of all, Ortberg's cleaned up Boeing's formerly messy balance sheet. Last fall, the company raised $21 billion by selling stock. Then in April, Boeing announced plans to sell part of its digital aviation business to a private equity firm for $10.55 billion. The plan is to pay down debt and focus on the core business of making aircraft. That's why the basic case for why the charitable trust has finally opened a position in Boeing. But with a bit more time tonight, I want to go into more detail. See, after a long period where the only real updates of note from the defense side of Boeing's business were negative, delays, cost overruns, we're seeing that side of the business gain some momentum, too. I mainly like the stock for the aerospace business, but defense makes up 30% of the revenues. So it doesn't hurt that the defense business is definitively turning around. Earlier this year, Boeing had a huge win on the defense side of the business when they won the contract to create the Air Force's next-generation fighter aircraft. And the numbers, well, here they've been improving dramatically. At an industry conference earlier this month, Kelly Ortberg went into some details about what the defense division is up to. In the old days, the company got in trouble with large fixed-price programs. The government pays a fixed amount, so if you have a big cost overrun, you end up losing a fortune. they're trying not to chase those kinds of deals anymore. And where possible, they're renegotiating their old deals. Hey, speaking of the defense business, Boeing's currently having a dispute with the workers, you might have seen this, represented by the International Association of Machinists Union at the fighter jet plant in the St. Louis area. The workers are currently on strike. This is similar to Boeing's labor dispute at the West Coast commercial aircraft facilities last fall, which was eventually resolved after a 2-month strike. I'm hoping something similar happens right here. It really would be great, though. I mean, longer term, though, I'm not worried. I'm not worried if you bought Boeing on weakness during the strike last fall, you'd now have a nearly 36% gain. These guys have been running circles around the unions for decades. I don't see that changing anytime soon. They're hardball players. Long story short, Boeing's now officially a charitable trust holding, thanks to the stock's recent pullback, so you should know the core case for owning the stock. The company's gradually ramping up production for its key aircraft models, the 737, 787, and it remains mostly on track with these efforts. Boeing's balance sheet is much, much better than it was after a huge recapitalization effort late last year, and now there's a line of sight to positive free cash flow in the near-term future, with the promise of $10 billion worth of free cash flow or more per year once the company gets its production levels up to its previously stated targets. Meanwhile, regardless of how you feel about the president's trade agenda, it's been phenomenal for Boeing, with some huge aircraft orders coming from the Middle East, Korea, the UK, potential of a massive deal still to come from China, assuming those trade talks don't fall apart. On top of everything else, we're finally getting reasons to be cautiously positive on Boeing's defense business. The bottom line, put it all together, and I think Boeing simply become too good to ignore, especially after the stock's recent hard pullback. That's why we pounced on it for the Charitable Trust and why you've got my blessing to begin a position tomorrow. Mad Money's back into the break.
Coming up, need some new investment ideas after the market's recent run to all-time highs? Cramer's highlighting some stocks that could give your portfolio a pop. Next.
Right now, we've got a high-quality problem. The average is making record high after huge rallies. Where is it safe to put new money to work in this market? Now, you can still find relatively inexpensive stocks if you know where to look. This weekend, we ran a screen searching for S&P 500 stocks with above-average growth and below-average price-to-earning multiples. At the moment, the S&P in the aggregate is expected to put up 12.5% earnings growth next year, and it sells for just under 22 times next year's numbers. You know, we want faster growth than that at a lower price. That's what you do a screen for. Turns out there's a surprising number of stocks that fit the bill, 104 of them to be exact. From there, I made some judgment calls. We booted the energy and materials names because I'm wary of those groups. That left us with 86 stocks. So we went through the list to find our favorites of those 86. Now, first, T-Mobile, which announced a leadership transition before the open this morning, with CEO Mike Sievert set to become vice chairman on November 1st, a bit of a surprise, and be succeeded by the company's current COO, Srini Gopalan. Now, Sievert's created a tremendous amount of value as he has been CEO, but I believe in this team. T-Mobile's on track to give you 19.4% earnings growth next year, yet it's selling for just over 18 times next year's numbers. Plain and simple. Next, from the consumer discretionary group, we've got two travel names. Royal Caribbean, my favorite of the cruise stocks, because it's the clear best of breed in one of my absolute favorite groups. And then there's Expedia, the online travel agency. Expedia is projected to put up 18% earnings growth next year, but it sells for 13 times next year's numbers. Oh, that is very cheap. In fact, it's much cheaper than key competitor Booking Holdings at 21 times earnings. So I say stick with Expedia. Booking's a very well-run company, though. After that, there's Dollar Tree. Now, that's the only member of the consumer staples that I like from this list. I think Dollar Tree can win in this environment as a destination for lower-income consumers who are searching for value. I like that they finally spun off that weaker Family Dollar business. And with the stock selling for less than 15 times next year's earnings with a 15% growth rate, again, that makes it a buy. Now, when we ran this screen, 34 of the 86 companies on the list came from the financials. Now, this is a great moment for the financial sector, as I've been trying to tell you that pretty much nightly. So I'm going to run through my favorites in rapid-fire format. There were a couple of credit card plays, including Charitable Trust holding Capital One Financial, COF, which just merged with Discover and is projected to have nearly 14% earnings growth next year, despite selling for just roughly 11 times next year's numbers. That's why I think it's such a buy. Then there's American Express, which just released a refreshed Platinum card. You might have gotten it this weekend, that I'm sure will be a hit, especially with millennials and Gen Z. Amex should have 12.6% earnings growth next year, just barely better than the market. And don't be surprised if the actual earnings growth surprises to the upside. At the same time, it's selling for less than 20 times next year's numbers. That's a bit cheaper than the overall S&P. Lots and lots of banks made the final list, and I really like two of them, one big and one small. The big one is Citigroup. Boy, is that strong. It should grow at a 28% clip next year. It trades at just 10.5 times the 2026 earnings estimates. Well, that's strange. Citi's made a remarkable recovery under CEO Jane Fraser. And even though the stock's had a huge run, it remains the cheapest of the big banks. That's why that disparity is going to close to the upside. For my small bank, you know what? I like KeyCorp. That's that Cleveland-based parent of KeyBank. We've had them on a bunch of times. Fine regional bank, underrated capital markets business to boot. KeyCorp's expected to grow at a 22% clip next year, yet trades at just under 11 times next year's numbers. Beyond the banks and the credit card issuers, Charles Schwab made the cut, and I'm a big fan of this retail brokerage house. Same goes for Chubb. That's the property and casualty insurance play that I think is best in show. There are even a couple of private equity stocks that look interesting based on this screen, like Apollo, which is now a leader in both private equity and private credit. It's projected to have roughly 19% earnings growth in 2026, but it sells for just 15.5 times next year's numbers. It's always traded at a pretty big discount to the market, though. What else? Now, we know healthcare has been mostly a wasteland this year, which is why only 4 stocks in the group passed the screen. Among those 4, the one that stands out to me is Insight, a biopharma company with 9 approved products, mostly in oncology and dermatology, plus a robust pipeline, which is why the stock's up almost 23% year to date. Still, Insight's expected to have 19% earnings growth, and it trades at just under 12 times next year's numbers. That's, again, way too cheap. A number of industrials made it through the screen, so let me cut to the quick here. Caterpillar, the machinery kingpin, has done incredibly well. It's up nearly 77% from its April lows. But you know what? I think it's got more upside. Stock's on track to put up 18% earnings growth, sells for 22 times next year's numbers. Cummins CMI works too. Their company's core truck engine business has headwinds from the prolonged weakness in the freight market, but Cummins has underappreciated data center exposure, making backup power generators for these warehouses full of servers that cannot go down. Finally, there's Jacobs Solutions. That's the engineering construction firm. We just had them on last week. Jacobs is involved in all sorts of designing and constructing data centers, as well as new pharmaceutical plants. They work for Lilly and some of the other advanced manufacturing facilities that are hopefully coming back to America. It should have 16% earnings growth next year, and the stock sells for 21.5 times 2026 estimates. Next, several quality tech names made the final cut. For example, Dell Technologies, which you know I've liked so much, they made it. And though the stock's had its ups and downs over the past couple of years, it's still a core player in the AI infrastructure. I also like Jabil. Boy, that's a great company. Contract manufacturer, all sorts of electronics. It's becoming an even more valuable partner for its customers this year amid all of this trade uncertainty. Now, there's only one single solitary real estate company that made our list, and that's BXP. It's a company formerly known as Boston Properties, with a portfolio of mostly high-quality office properties in 6 major cities on the East and West Coast. Now, BXP trimmed its dividend earlier this month, which I thought it was going to really kill it, but they did say they needed the cash to devote to growth projects, which is why I think the stock bounced right back. Even after that, it's still got a 3.7% yield. Finally, I've got a utility that made the final cut, and it's called Entergy. That's a New Orleans-based utility. We've profiled them many times with a service area spanning from Mississippi to Texas. Entergy has a number of things going for it, from Meta's construction of a massive $10 billion data center in Louisiana to the ongoing build-out of liquefied natural gas export facilities. It's growing a little faster than the average stock in the S&P with a slightly lower price-to-earnings multiple. So here's the bottom line. Sometimes it can feel like there's nothing left to buy. You often hear about that. People say it's all moved. When you do a little work, you can find a host of cheaper-than-average stocks with above-average growth. Any one of the stocks I just mentioned is certainly worth your time looking into. Sava in Arizona. Sava.
Hey, Jim, my friends and I work hard in the gym. We can't stop eating our slop balls. Therefore, Jim, what is the catalyst that's going to get Chipotle to move up? Is it an easier environment for consumers, or is it something we need to hear on the next earnings call?
I think it's a combination, Sava, and it's two things. One is that we absolutely have to have lower commodity prices, because I think that a lot of their commodities, particularly beef, really, really hurting. And then the second that you need is you got to have a clear roadmap for growth. And right now, I don't see that. It has to happen, or else people are not going to buy the stock. Let's go to Stephanie in Colorado, please. Stephanie.
Hello, Jim. I'm a frequent watcher of your show. Thank you for taking my call.
Oh, of course. Thank you for calling.
Yes, I am calling about Chevron. I've owned it since December 21, and it's a nice little dividend. And so I was just wondering about the future. Since the merger and purchase of Hess this July, and wanted to know, is it a buy, more, hold, or sell?
It's just a hold. The reason I say that, even though I think that Mike Wirth's doing a great job as CEO, is that I'm not a believer in the energy stocks. I actually sold the only energy stock for my travel trust not that long ago, because I just don't think that they have the kind of growth that I want out of owning a stock. We like growth stocks here. We have a predilection for it because that's how big money is made. But thank you for the call. Now, if you do a little work, you can find a host of cheaper than average names out there, ones that still offer solid growth too. Hey, much more Mad Money at, including my exclusive with Quantum Player IONQ. Then it's getting difficult to own industrials in this tape. I'm taking a look at why there are so many sellers and why some other sectors just aren't working like they should be. And then, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. This market's been so enthusiastic for high-flying speculative stocks that you simply can't afford to ignore them. Take quantum computing. This is an idea that's been around for ages, but it always seemed pie in the sky until the past year or two, that is. Now lots of people are betting that it could become a reality much sooner than most people thought even just a couple of years ago. Consider the case of IONQ, okay? This is the largest company in the space. Now has a $23 billion market capitalization, with the stock up a quick 64% since we last spoke to the CEO in late July. Most of those gains have come in just the past couple of weeks since the company held a very successful analyst day and followed that up with more positive news, including last week's announcement that we got to find more about. The company signed a memorandum of understanding with the U.S. Department of Energy to advance quantum technologies in space. So let's take a closer look with Niccolo De Masi. He's the chairman and CEO of IONQ to learn more. Mr. Masi, welcome back to Mad Money.
Wonderful. Great to be here, my friend.
Well, you have had some run, and it looks like many of the things that you said would come true have happened. I want to go with this most recent news, the memorandum of understanding with the Department of Energy about quantum and space, because this would be very interesting to our viewers.
Yes, well, remember, we're the biggest player in the space, as you correctly announced at our introduction. And we're the biggest player not just in computing, but also in networking and now sensing. And we also own a signals intelligence platform to do quantum key distribution in space, right? So we've been busy this year putting together the pieces for precisely this sort of partnership. We are thinking big. We are thinking about projects, as large as Golden Dome and how we fit into that. We're thinking about the transatlantic partnership. I was just at Chequers with President Trump and Prime Minister Starmer, obviously, talking about what we can do for the alliance, as well as what we can do for the Five Eyes and beyond. So I agree with your introduction completely, Jim. Quantum is here, and quantum is going to gallop forward. And I think the market has really solidified behind INQ as I like to say, the NVIDIA of the quantum space.
Well, I like that, but I know you guys are partners, but I thought of you today when I heard about all the money going into data centers, because you have said that in 10 years, we're probably going to look back and think how crazy it is that we thought nuclear reactors that are powering data centers, size of football fields in the future. You're talking about burning much lighter and a much smaller footprint, which to me seems a lot more rational than what we've been talking about.
Yeah, I think in a lot of ways, today's GPU computing policies look like energy policy, if you will. And you think about the marginal costs and you think about how that sector is run. It's really driven by energy. You're correct. Our analyst day, we had some big news. It was mostly the announcement of our 100-qubit system, our AQ64 system, as it's called, which we announced as being 36 quadrillion times more powerful than the most powerful machine in the marketplace from our competitors. Now, that's a machine that takes approximately 1 billion GPUs to simulate, if you try to simulate what it can do. And it's obviously running off of a wall socket. It's not running off of a small modular nuclear reactor or a football field. It's a machine the size of a few commercial refrigerators. So it's a harbinger of what is to come. We're very much just getting started here, but you remember from last time that we're inflecting at a double exponential rate, which is probably what's driving our analyst community to understand finally what's happening at IonQ, which is it's not Moore's Law where you double every 2 years in compute power. We double every time we add a logical qubit. So machines can become hundreds of millions of times, billions of times, trillions of times more powerful between generations, right? And it's literally changing the world, sometimes, every few months as we add more logical qubits.
I want to go back to what you said when you're over with the president and Prime Minister Starmer. Now, what you just described would be ideal to shoot down anything that was sent at our country. And I have to believe that whatever was lobbed at us will almost seem like in slow motion to IonQ's prevention if you're involved with Golden Dome.
Well, I can't confirm and deny where we are on amongst these initiatives, but I think it's safe to say that we're the only company in the world who is able to stitch together space, sensing, quantum computing, quantum networking, right? So that is a unique MOU. It is a direction that we're positioning for and we are resourcing. And it's a position not just in the US, obviously, but for the Five Eyes and NATO. I think sovereign systems are in demand around the world. And I think people are recognizing that quantum is about sovereign systems and sovereign capabilities. The transatlantic partnership, is in full bloom. I think there was $250 billion of investment that went into Checkers from the US into the UK, and we were a proud part of that. I was there with other great CEOs of our era on both sides of the Atlantic. And so we hope to be a big part of strengthening national security and national economic security for both the U.S. and the U.K. and ultimately the Five Eyes and NATO.
Okay, so Nicola, one of the things that intrigues me is, at what point do you decide, you know what, let's go for some profitability? And I will preface this by saying I wouldn't. I would go for growth. Because as long as you're going for growth and your market cap's where it is, who is to say why you need to constrain yourself by profitability? But I am sure there are people maybe on your board or your investors who say, okay, enough is enough. Now let's start making money.
Our shareholder base has been very supportive, not just since I took over, but, previously, over the last 5 years since we were the first public company in the sector. We are executing well, right? We've expanded the vision and we've expanded the TAM from just computing to networking to sensing on the ground, up in the heavens. We've accelerated our technical roadmap a long way, both organically through the right hires and inorganically by doing things like buying Oxford Ionics in Oxford, England. We also recently acquired Vector Atomics to give us the leading position in the quantum sensing space. And so our story now is not just about the verticals of computing, networking, sensing, but it's how we stitch them together. And so I'm very focused on building that long-term customer ecosystem and customer moat, if you will, by being able to land and expand with any one of these quantum services, and also being the only company in the world that can deliver the full quantum internet, right? So capturing data with quantum sensors, computing that with our quantum computers, transmitting that securely across quantum networks, and being able to do that globally on the ground, and of course up in the heavens. That's where our customers want us to go. So I'm very proud of our shareholder base. I mean, they understand what we do. They're very inquisitive, both at our analyst day and of course just on a daily basis, and they follow us in incredible depth. So I'm proud of the global nature of it. I'm proud of our global impact. And we obviously continue to drive the business in a direction that our shareholders seem to appreciate, support, and understand.
Now, one thing that did your CFO said something that intrigued me. You're talking about the different kinds of threats and how Palo Alto and CrowdStrike, those two companies we like very much, that none of them would work against the threats that are quantum. Now, that scared me because these are people we count on to be able to protect us.
Yeah, so quantum networking, which is a core strength of ours, is a requirement in a world of quantum computing ubiquity down the road. And it's certainly, I believe, a very much good to have, if not a requirement today, if you think about classical cybersecurity threats. And so I like to always say, Jim, that you can spot our quantum networking customers because they're the ones that are not in the news for data breaches and cybersecurity breaches, okay?
Right.
And they are some of the world's largest financial institutions and telcos. And at the end of the day, what's beautiful about QKD, quantum key distribution, which we are the leader in globally, is it's not just that it's practically unbreakable, it is theoretically unbreakable. So even in 50 years' times, no matter how powerful quantum computers become, it will not be breakable. And so you have none of this download now, decrypt later phenomenon that you have right now for classical encryption. There's a game of cat and mouse going on right now where there's data breaches and people are grabbing data, waiting for quantum computers to be able to come along and crack all that, obviously. And unfortunately, we're the good guys here, right? But there's going to be bad guys. There always are in every computing revolution, right? And so QKD is your solution today and in the long term and the medium term to keep your data safe.
All right, well, I'm rooting for the good guys. Niccolo De Masi, Chairman, CEO of IONQ. You've really built a great company here. Don't sacrifice growth for profitability. Don't listen to those people.
Totally agree.
All right.
Totally agree, Jim. And you still owe me that co-host from last time. So we can talk full hour next time about that. Growth over profitability.
Man, buddy's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. Great remember that's from Ralph Goldman. I'm saying the stock started by buy sales, but I know the car. That's time. I step prepared to go. Playing it sound. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Crazy about start with Jim in New Jersey. Jim.
Jim from Violin, New Jersey there, buddy. You mentioned us last week. How you doing?
I am doing well. How about you?
Well, I'm doing great because I'm talking to the Pope of Prosperity, man. It used to be last decade when you were deployed and stuff, you'd say, what would Bruce do? Now that I'm retired, thanks to you, I say, what would Jim do? So I have a question for you, buddy. All right? You ready?
Yeah.
All right. A company, I finally got their shares down to about $39 a share, okay? I averaged it out to that. The company just expanded itself down in Georgia. They're opening up a big facility to build electric vehicles. You know who I'm talking about.
I'm talking about Rivian. I'm talking about Rivian. Now, here's the problem. Here's the problem, Jim. They spent a lot of money on that factory. I think that if we have a slowdown and the Fed doesn't bail us out, I think you're going to find that stock, you can buy that stock lower. So I say wait. Don't pull the trigger here. So it's up on a spike. Thank you for the kind words. Let's go to Barry in Louisiana. Barry.
Hi, Jim. Jim, I'm calling about Energy Fuels, ticker UU.
Okay, I'm going to give you this straight on Energy Fuels. Remember what I said about Oclone was at 33. I said I will not go against any uranium or nuclear stock. This one's at its 52-week high, and I still will not go against it. And I've been behind this one a long, long time. Let's go to Greg in Maryland. Greg.
Hey, Jim, calling to see what you can tell me about the Chemours company, stock symbol CC. Thank you.
I think it's chronically undervalued, but I have to tell you, because people continue to think that it's got problems with forever chemicals. I don't think it does. I think they put it behind it, but I'm not going to touch it because the plaintiff's bar is that powerful. Let's go to Frank in Pennsylvania. Frank.
Booyah, go Birds. My stock is Gilat Satellite, GILT.
Again, anything satellite, anything air, anything that is like this, whether it be flying cars, it doesn't matter. One headline and this thing flies. I am going to tell you that even though that's a 52-week high, you can still buy the stock of Gilat Satellite. Let's go to Joshua in Texas. Joshua.
Professor Cramer, booyah from the great state of Texas, and thank you for everything you have done. Thank you so much for my portfolio being up 174% year-to-date thanks to you.
Whoa!
Yeah.
Thank you.
I got a question. AST Space Mobile.
Well, you said it. You heard the word space. Now, I know people are going to say, what the heck is Cramer smoking? Well, actually, I've been right about every single one of these, as you know. But what really does matter to me is that this is your spec. You're allowed to have a spec. I say it in making money anymore. All you got to do is have one spec. You're allowed it. You can't have two unless you're very, very young, and that ASTS is a perfect spec. Let's go to Rui in New Jersey. Rui.
Hey, Jim. Hey, booyah. How are you?
I am good. How are you?
Well, thank you. I'm calling in regards to ticker symbol AMBA, Umbrella Inc.
You know, it's been around for a long time. It's finally getting there, but I think it reflects all the good news already. I'm going to have to say no to that one. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, growth stocks are all the rage in today's market, and Cramer's revealing which sector is benefiting the most from the move. Next.
Gotten really difficult to own the industrials here, including some of them we mentioned earlier in that screen of good companies. It's almost as if the market gods have determined that unless you're somehow involved in the data center, you just aren't going to make your quarter. Of course, I don't believe that for a second. There are plenty of industrials connected to growth areas like aerospace or road building or the giant infrastructure spending package left over from the previous administration. It's not just the data center. Problem is, nobody on Wall Street seems to care. Why are so many money managers so predisposed to want to sell these stocks? I think it's because the industrials are now perceived as no-win stocks. And the psychology here is actually pretty interesting. Most of the industrials are heavily tied to the strength of the broader economy. If the company is going to make its quarter, that could mean the economy is too strong. And if the economy is too strong, the Federal Reserve might not be able to cut rates continually, which is what so many of the bulls want. Basically, if the industrials are doing well now, Wall Street assumes that the Fed won't give them the rate cuts they need to continue to do well in the future. On the other hand, if the economy is too weak, most of the industrials will miss the quarter anyway. It's a weird situation where bad news is bad news and good news is also bad news. I saw it firsthand last week when we got the update from DuPont, which is splitting into two companies, a fast-growing electronics business and a very steady industrials, healthcare, and water business. These are two excellent companies that can bring out a lot of value once they start trading separately. We've told members of the investing club that the sum of the parts could be as high as $100. And that is a huge gain given that the stock currently trades at $78 and change. The spinoff comes in November. That's not that far away, but it's too far away for this market to deal with, conceivably 2 Fed meetings away, which is just too hard. The bias against the industrials is so strong that money's been pouring out of this group all year, even as I suspect that many companies in the cohort will end up beating expectations. The Fed's cutting rates, so historically this would be a good time to buy, not sell this cohort. It's a little nuts. Oddly, the only groups worse than the industrials are the consumer packaged goods stocks and the healthcare stocks, the very groups that are supposed to do the best in the slowdown. Normally, these are recession stocks, and the industrials don't trade in the same direction, but that's the bizarre situation we find ourselves in. Again, another set of oddities. The consumer packaged goods companies are being hit hard by inflation. Procter & Gamble and Colgate are getting pummeled over raw costs. The Fed doesn't want to see them raise prices because that's exactly where the inflation is most visible. The healthcares, oh boy, one look at Kenvue, the Johnson & Johnson spinoff. That's the one that all day today people are talking about. It's over-the-counter drugs. It shows you how problematic this group can be. The administration, prodded by Health and Human Services head Robert F. Kennedy Jr., seems convinced that there's a link between Tylenol and autism, even though the science says otherwise. Now, that could be a devastating blow to Kenvue. I was going back and forth with customers at Total Wine & More this weekend, signing my wife's Phosphoro Mezcal bottles. We had quite a few members. Thank you for coming down. I always ask, well, hey, what do you like? What do you own? Hey, almost no healthcare companies, highly unusual, save Eli Lilly. But they all say the same. It's too difficult to own them, which is why, in the end, you need to own real growth stocks, and the only real growth is tech. It won't be kept down by inflation. It won't be dulled by recession. There's just too much demand for their goods and services and not enough supply. Ooh, that's the perfect combination. That's what this market wants, even if it means the stocks of many high-quality industrials get left in the dust. I'd like to say, as always, a bull market summer, and I promise I've had it just for you right here on Mad Money. I'm Jim Cramer. I'm going to see you Wednesday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and/or subsidiaries warrant warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.